Good morning, good afternoon, or good evening, depending on where you're joining us from. I'm Thal, the EMEA editor for Reuters Breaking Views, and I'm delighted to welcome you to our latest predictions event. Our topic today is, will the market boom continue after COVID? It's hard to think of a more relevant subject. A year ago, the city of Wuhan in China was preparing to lock down its entire population in an attempt to constrain the spread of a new and unknown virus. If I told you then that more than 2 million people would die in the coming year, the global economy would be tipped into a sharp recession, entire industries would be upended on life support, and hundreds of millions of people would be confined to their homes, you would probably have been shocked. If I then told you that the S&P 500 index would be 15% higher in a year's time, the yield on 10-year US Treasury bonds would fall from 1.8% to 1.1%, and the spread on US high-yield bonds would be about the same at 4%. You would probably have been surprised. And if I then told you that Tesla's market capitalization would be nearly $800 billion and the value of Bitcoin would be $40,000, you probably have told me I was mad. Yet here we are. So with that, big reminder about the difficulties of seeing into the future. We're going to talk about what's happening next. I'm fortunate to be joined by some very distinguished investors who will give you the benefit of their insight over the next hour or so. I'd also like to encourage questions from the audience. So if you're following on our main event webpage, you'll be able to see a box on the side where you can type your questions, or you can log into Slido and using the event code #BreakingViewsPredictions2021. So to our panel, we have in alphabetical order, Fabiana Fedeli, Global Head of Fundamental Equities of Robeco; Lynn Forrester, the Rothschild, the founder and managing partner of Inclusive Capital Partners; Evie Hambro, Global Head of Thematic and Sector-Based Investing at BlackRock; and Rishi Kapoor, Co-CEO of Investcorp. And I'd like to start with you, Evie. In a few hours from now, Joe Biden will be sworn in as the US president, or at least we're fairly sure that he will. How do you think the new administration is going to impact financial markets?
Peter, thank you very much for having me on today, and you know, it's a great pleasure to be able to speak to you. I mean, that is got to be one of the big questions for 2021. A shift in transition of leadership of such, you know, scale and breadth in likely policy is going to have profound impacts on markets during the duration of this presidency. You know, just to start with, looking at the environmental impacts and a complete shift in spectrum there from one side to the other. You know, large expectations of re-signing up to the Paris Accord, a lot of fiscal spending aligned to green-related policies, whether that's green-related infrastructure, renewables, etc. Yeah, this is going to have a major part on the US economy and also on the global economy. So I think from our perspective at BlackRock, we are very excited about this. You know, it's complete alignment with our move on sustainability and everything that we've made public around that last year and the year before. And I would expect that to continue in terms of our direction of travel. The other factor is going to be around trade, where, you know, we had a previous president who had a very strong focus on trade, especially with China. I think it's going to be interesting to see how that evolves under the Biden presidency. Maybe more of a focus on human rights rather than necessarily on trade, and maybe trade as a tool to achieve the outcomes on human rights that they desire. So I think it's you know, two very big factors on their own, which are going to have an impact on markets, and you know, we're obviously thrilled to see how this evolves.
Great. Well, thank you, and I'm sure we'll come back to sort of the new administration and discussion. But just turning to Rishi Kapoor from Investcorp, so as a co-CEO of a big alternative asset manager, you're looking at across a range of asset classes. I wonder what the pandemic and the response to the pandemic has done to your expectations about long-term interest rates and how you expect those to influence the markets in which you're investing.
Yeah, thank you, Peter. Let me start off also, first of all, by wishing all our viewers and also by saying thanks to you and Breaking Views for having me join you all on this August panel. I mean, in the abstract, Peter, if I take your question, low interest rates is bound to be helpful, beneficial, provide a tailwind to a private markets manager, alternatives manager like Investcorp. However, there is a sting to that tail a little bit. And that really stems from the fact that, if you look at a typical asset pricing model, for instance, the discount rate, the cost of capital, the expected return, whatever you want to call it, is made up of two broad components: the risk-free rate and the spread on top, the risk premium on top, right? The risk premium is the latitude you have to allow for execution challenges, idiosyncratic risk inside of a company or a sector of the economy that you're investing into, et cetera. And typically, the risk-free rate is the counter buffer against some volatility in the premium, right? If there is a macroeconomic challenge, for instance, you could rely on the risk-free rate going down to buffer an increase in the overall cost of capital. And what is happening now is, with most of the developed world anchored at near zero interest rates, valuation expectations in the private markets have naturally shot up, and pretty much everything is priced to perfection. So whether you're looking to buy quality or you're looking to buy just the middle of the road average asset, your ability to buffer any execution challenges with the risk-free rate of return going down in the future is very limited, and therefore it requires much greater focus on buying the right asset where execution risk is minimal, where there is inherent resilience built into the business model, such that you're not piggybacking off or relying overly on the macroeconomic market conditions, because those are not going to come to your rescue. Everything is priced to near perfection.
Very good. Fabiano Fedeli from Robeco. I mean, just following on from that a bit, and we obviously saw this huge surge sort of during the lockdowns for stocks that were perceived as sort of benefiting from COVID or being sort of immune to it. And then big rotation around the time that the news about the vaccines came out. Looking at the sort of relative valuations and also the overall valuations, how do you see that evolving?
Peter, first and foremost, thank you for having me, and also thank you to our viewers. I feel a little bit luckier than Rishi in terms of still seeing some opportunities in equity markets. Last year, I would define it as a bear market rally, where really the focus was on stocks that were COVID beneficiaries and COVID defensives, and that really shot the prices up. One other phenomenon that I'm not sure that is really looked at it that much in detail, but has also been this huge retail participation in the market, which probably has also created a headline effect on certain stocks. But what that has left us with is this huge polarization in terms of valuations and performance. And that is what you referred to, and it has started to play out at the end of the year. Overall, this year, we are constructive on equities overall, and we do believe that the rotation will continue because it's underpinned by all of what Evie has already discussed, is the vaccination program and also the obviously an improvement in the economic conditions, although very gradual. The one thing I would caution, however, is that we shouldn't buy indiscriminately in this market, because a lot of those stocks that have been, if you want, hurt by the consequences of the lockdowns will probably never come back as we knew them. So there's a really need to be selective. There are a lot of stocks out there that, yes, have been hurt by COVID, but still have solid fundamentals. And as the economies will open up, will come back with their earnings upside. But there are also some that, frankly, will probably never recover. And so there's really that selection issue right now that we have to really pay attention to.
Yeah, I'm sure we can dig into that a bit more as well. But I just want to bring Lynn into the conversation. Lynn, I mean, we've seen this focus on. I mean, as Evie said, look, seems like the Biden administration are going to take the U.S. back into the Paris Accord. A lot of talk about green investments and so forth. You've been talking about the need for capitalism to be more inclusive for quite a long time. I think basically since the last financial crisis. And you might think that an economic and health emergency like the one we've been through would sort of push such questions to the side. How do you sort of see the balance of priorities now?
Thank you, Peter, for having me, and it's an honor to be with my fellow panelists. And happy Inauguration Day. As Ursula von der Leyen said today, it's a new dawn, and Joe Biden calls it a new chapter. So it is a little overcast in Washington, but soon to be sunny, and I think that the pandemic has created a crisis worse than what President-elect Biden inherited when he was vice president with President Obama and the financial crisis. And I also predict that the response will be different. He has committed to 100 million vaccinations within the first 100 days. The $1.9 trillion COVID package is likely to be sent very quickly to Congress. I agree with Evie that there's going to be a huge push on climate. But if you look at the makeup of the administration that he has nominated, this is a group that will care very much about what Paris calls the just transition. So I predict a lot of focus throughout the government on fair wages to people. There'll be a national minimum wage proposed, and even the state of Florida, which is a so-called purple state, goes Republican and Democrat, has voted for a $15 minimum wage, which, by the way, is $30,000 a year. At $750, people are earning $15,000 a year. And I think the corporate world is making an enormous mistake by arguing against worker fair wages and worker voice. I see that there'll be a lot of power in the hands of Marty Walsh, the new labor secretary, Gina Raimondo. Commerce cares a lot about this. So I think there's going to be a lot of attention on worker conditions. Janet Yellen, our Treasury Secretary designate, when she was the head of the Fed in 2014, gave a very unusual speech in Boston about inequality. It sort of shocked people, but she did it because she cares. I think she cares about inequality and inclusion in the way that Mark Carney, as head of the Bank of England, cared about climate. So I think that's going to go very high up the agenda. And I think financial and business people should become aware that ESG, in a way, has another E, and it's the employee. It's employee, environmental, social, and governance with this administration.
Peter,
Okay.
maybe if I could
Yeah, sure.
just jump in, because first of all, I really very much agree with what Lynn said. And one of the elements that we have observed also talking to our clients is that the COVID crisis has really put the focus on the importance of managing your employees, your human resources well. And we have seen also from a client perspective, a lot more interest in how we look at the S in the ESG integration in our strategies, and how much attention do we pay on how the board and management looks at human resources. And I think this is here to stay, is another one of those changes that COVID has triggered, and most likely we will see just staying in the market.
Can I just to pick up on what Lynn was saying, and maybe and sort of spread that around the group a bit, but maybe Evie, you have some thoughts on this. I mean, you know, there's this anticipation of a lot of focus on from investors and also from governments on green investments, on prioritizing green investments. How, as a sort of financial investor, how do you look at the opportunities there? And because we've seen obviously a huge run up in some of the sort of perceived green stock, the value of green stocks, and sort of also, you know, kind of oil stocks and stuff getting a bit of a discount. How do you weigh up the sort of the opportunities there?
Yeah, so I mean, I think that's the question we're all debating. You know, the single biggest factor today is the momentum of capital that's going in the direction of green investments, as you point out. And the scale is, you know, way ahead of anybody's expectations. And this is having lots of impacts. You know, the first is obviously an impact on how businesses are run, because in order to be compliant to receive this capital, you probably have to change from the way that you were doing business before. And for some businesses, that's an enormous change. And for others, it's probably incremental. I think the second factor is what that flow of capital is doing to both the ratings that businesses trade on, but also the cost of capital. You know, we've seen just recently, you know, companies that are compliant for ESG capital issuing green-related bonds or some such instruments at incredibly low interest rates. You know, we had a European company this week issue a long-dated bond with actually a negative coupon attached to it. You know, so, you know, investors have to pay every year to own this bond. You know, that's an incredible concept. You know, something that people, as you were saying earlier on, you know, people weren't forecasting some of the things you outlined with regards to market capitalizations or pricing of securities. You know, to see a European corporate issue a bond with a negative coupon where you have to pay to own it every year is staggering. It shows you the quantities of money that are going in this direction. Now, if you're the beneficiary of these flows, obviously you will end up with an advantage relative to your competitors who aren't receiving that. You know, whether it's the rating that you trade on and therefore the ability to issue shares in a less dilutive way, or access to long dated capital at a far lower cost than your competitors, and therefore the opportunities of buying their assets or going into their space with a lower hurdle that you need to earn to be able to finance those bonds. So I think we are seeing this flow of capital completely adjust the pricing of securities. And I don't think that is going to change in terms of, or reverse in the near term at all. If anything, it's likely to get bigger and more pronounced. Through time, though, obviously, everything mean reverts. And we will see businesses move back to more fundamental valuations. But that could be a long-dated prediction because the scale of change is so big and happening so quickly that it's likely to have, you know, very, very significant impacts on these factors.
Yeah. Okay. Sorry. Go ahead.
I would add to that I believe this year there's going to be more focus on the impact of ESG. That it's not going to be enough to just label something an environmental or an ESG product. That there's going to be accountability for how managers are forcing change in the companies that they invest in. And I also see that there'll be an interest, and to that point, I mean, 5 senators, Evie, I don't know if you want to speak to this, but sent a letter to BlackRock and said, you are getting the lion's share of ESG money, but you're voting against ESG proposals. When are you going to start walking the walk? And those senators are now responsible for committees, and probably 3 of them would be in the administration, but they want to keep the Democratic control. So I think that there's got to be serious action toward the achievement of ESG. And that's where ESG gets its impact. It's no impact if you invest in a company that never was part of the environmental problem. It's impact if you go into the problem. And I think we're going to hear an expression of greening, where you invest in companies that are greening, because those are the companies that are most actively solving the problem. Because if the environment is a problem, running away from it doesn't solve it. investors have to run into the problem, and they have to help the companies that are part of the problem become part of the solution. I think that's going to be the shift of the smart money that cares about ESG. It's not enough to just have the label. It's dangerous, in fact, I would say.
And in fact, regulators are already moving in that direction. If you look at the European Commission, they're already demanding from this year all asset managers to actually prove that they really have an impact. And everyone is scrambling because this is still a very new area. I mean, ESG has been around for a long time, but how do you measure it? Do you have an industry-wide standard? So there are a lot of things that have to be figured out, but the regulator has decided to take a stance. And actually, we really welcome that stance because it means that it's going to bring everyone to a higher level of compliance.
Yeah.
This is where I'm hoping
the
US works more closely with the EU. And I think we have a chance because there's a movement in America too to understand the need for standardized measurements. So there's real accountability. Because if we don't have real accountability, we're going to lose the investor, we're going to lose the public again, and we will have solved nothing by this so-called movement toward inclusive, sustainable capitalism. We have to have system change.
I think we should.
And if I may.
Yeah, go ahead.
Yeah, no, thanks, Peter. If I may actually add a perspective to what Lynn and Fabiana and Evie pointed out, which I completely agree with, by the way. But looking at it from the perspective of the private markets, the sense I have, Peter, is that 2021 is the year when, it's an inflection point almost for the private markets in terms of their adoption of ESG on that adoption curve, on that maturity curve, if you will, where most private managers are going to transition from their earlier positioning, which was more outward facing, tick the box, attract investor capital, put a few headlines, abide by a few slogans, risk mitigation based, let's not incur any large reputational risk, to actual opportunity seeking, right? You're actually going out there. And as I think Evie alluded to earlier, you're looking to invest in businesses that create sustainable value in a sustainable manner by lowering their overall risk profile, by lowering their overall cost of capital, so that the future generations of owners of those businesses, of those assets, are reassured that those streams of cash flow that they have invested behind are going to be there for them to participate in. And that, that shift, that migration, if you will, in the private markets is obviously most evident in private equity, right? Because that's where you have the greatest influence. Your ability, as more often than not, as a controlling shareholder, as an active shareholder, as an active owner, to work with the management teams and the boards of the underlying investee companies and focus on outcomes rather than just ticking the box with a certain set of KPIs, but also not trying to be everything to everyone, right? Selecting the issues that are near and dear to your own corporate purpose, if that's the case, or to your investment strategy as may be relevant. Because, like if you look, for example, at the Sustainable Development Goals, right? There are 17 of them. It's not practical for an asset manager to focus on all 17 Sustainable Development Goals for every investee portfolio company all the time, right? It's just very, very difficult to do that. But there are, certain subsets of those goals that would apply in either in certain sectors or under certain investment strategies, or that simply happen to be the core values of a particular investment management firm that you can zero in on. And from the outset, from the origination phase to the investment decision, through the actual ownership period and the portfolio monitoring, all the way through exit, you can actually look at outcomes literally step by step, taking the firm at one level, from one level to another level, which is meaningfully higher, right? It's not a yes or no, it's a continuous improvement. And that's where certainly I see Investcorp going, and not surprisingly, many of our peers going. That's for private equity, the same to a lesser extent because of practical considerations, again, applies in private credit and real estate as well.
Evie, is there anything on that you want to come back on?
No, I think it's all very sensible comments, and I would agree with them. And I think, obviously, we are just ahead of my boss's new letter to the market. So I'm sure there'll be lots to digest within that when that comes out. I would say on voting, just without anything specific to the comments that Lynn had made, just because there's an environmental notice put up for voting doesn't mean it has to be voted in favour of. I think each resolution has to be looked at in its own merits and to be decided what the benefits are of voting for or against that and what can be achieved. I think the other comment also to think about is engagement doesn't have to also be in the public domain. Engagement can happen behind the scenes as well. And I think that from my experience of what we've done over many, many years, probably our most successful outcomes with regards to engagement tend to be done without the glare of media attached to them. And so I would be pretty supportive, actually, of the way that we are going about this.
Okay, thank you. It's really interesting. I want to tackle sort of another topic that is which is there is a big debate at the moment, which is the possible return of inflation. It seems to be keeping a lot of people busy. I mean, maybe Rishi, could you start just by giving us a sense of what your expectations are and kind of how people can manage for it, because it seems like a lot of investors are not really prepared for that possibility.
I mean, I suspect you're right, Peter. The sense we get is a lot of investors are reconciled to the notion of lower forever, or if not zero forever, kind of. And that's not surprising because people tend to over-anchor or over-index to recent events, right? However, at the back of our mind, recognizing that at the end of the day, we are investing in assets with a typical hold period of 5 years or sometimes even longer, much longer. We have to always be cognizant of what happens, not just in the next 5 years or what might happen, but what might happen in the subsequent 5 years, because the person that is going to buy the asset off of us is going to be looking at it from that subsequent 5-year perspective. And one of the things that we are in particular focused on is referring back to the earlier comment I made with respect to the low interest rate environment and what it's doing for us in the private markets. On one hand, no doubt, investors are having to stretch for yield, no doubt, right? Returns from traditional asset classes, particularly fixed income, are so low that whether you're a private saver or an institutional pension plan or equivalent, you simply cannot meet your hurdle rates of return for your retirements through just pure participation in the baseline fixed income asset class. And those sources of yield are typically available through encashing the liquidity premium embedded in private markets, hence the tailwind to alternative asset classes. But within alternative asset classes, again, not surprisingly, we see investors heavily favoring those asset classes that provide a natural hedge to inflation, being in particular yielding real estate, where a big component of the overall return is in the form of rental income that is naturally indexed to overall underlying CPI levels. Infrastructure is in a similar vein. And you see, it's not just about lowering duration through greater participation in current income and current yield. It's also about indexing against a future tail risk around a rising inflationary scenario that we all feel, by the way, most central banks today are reconciled to accepting for a more prolonged period than they would have in the 80s and 90s, just given the very long period of low inflation that we've experienced over the last 10 plus years. In the private equity space, it's a bit of a more nuanced analysis for us, because the return of inflation in private equity actually works sometimes quite well because it gives you pricing power. And since you are typically doing leveraged buyouts, it's a little bit like how governments finance themselves. Some economic growth, some inflation is good when you're running a leveraged balance sheet. But runaway inflation leading to a steep increase in borrowing costs is not. Right? And therein, a lot of our focus, for example, particularly in the private credit space, where we are a significant CLO manager globally, is to invest in matching assets and liabilities such that an increase in interest rates is a net positive to us rather than a threat or a risk. And you're seeing that, Peter. I mean, if you look at some of the recent inflow and outflow statistics, money has come out of ETFs favoring fixed income securities and has gone into ETFs favoring floating rate loans and bank loans and so on and so forth. That's a microscopic, anecdotal piece of evidence, but at a very kind of macro scale, you see there is a clear sense that in 2021, if the economy rebounds in the second half and the pent-up consumption demand that has been repressed for close to a year now leads to a rapid rise in prices and CPI and inflation rates, this is a good way to hedge oneself against that.
Maybe if I can ask you, Lynn. I mean, I'm just going back to some of the things you were talking about earlier. I mean, one of the questions about inflation, it doesn't seems likely that as economies come roaring back, if and when these restrictions are lifted, there's obviously a lot of pent up saving and a lot of pent up spending potentially. But one of the big questions seems to be to what extent this then ultimately feeds through into wage inflation. And I guess from your perspective, maybe sort of if we had prices going up but people didn't necessarily get paid anymore, then that wouldn't necessarily be the best outcome.
Well, that's kind of a perverse place to start. I mean, if you look at the past 40 years, worker productivity is up 60%. The S&P is up 7x. CEO compensation is up 600%. Worker wages are up 12%. So I don't think I'm going to go crying about wage inflation for people who are just barely making it. I mean, for a country like any of us live in, to have so-called working poor is outrageous. And to have an economy with trillions of dollars of government subsidy and people on Main Street are still suffering, that's just not acceptable. And if we want to know why we ended up with Donald Trump, it's because we sort of thought that was acceptable, that the gains going to the top would just last forever because somehow they're deserved. So I'm not worried about wage inflation for the worker or for the middle class. And I think it's a big mistake to focus on that as some kind of macro issue.
We have exactly the same, if you want, issue that Rishi pointed out, which is runaway inflation is not good for secondary market, but some inflation is equity markets, but some inflation is actually good. So if you look at our expectations for inflation overall this year, we do see inflation maybe coming in a little bit above, say, for example, in the States, the 2% level just for the quarter after March because of energy price comparisons. But for the rest, we still believe that inflation will be quite benign over the year. And that actually continues to underpin our constructive stance on equity markets. And if anything, a little bit of an increase in inflation, which comes on the back of an increase in the economic outlook, it is actually good for that rotation that we were talking about in more cyclical and value-oriented stocks. So it's just constructive for now but that is not our outlook, definitely not for this year. We get to much higher levels of inflation.
Right. Evie, you're a long-term gold watcher, and obviously gold has been historically been seen as the ultimate sort of inflation hedge. I think we touched $2,000 an ounce at the end of last year. How do you look at that as an indicator of what people think might be coming?
Yeah, no, it's thanks, Peter. I would share some of the views that have already been expressed. We are looking out into the future where the global economy will start to recover as vaccines take hold and the pandemic risks start to recede. I think we all know there's an enormous amount of pent-up consumption that will be expressed in the economy, probably starting in the second half of this year and rolling into next year as well. The range of estimates there, even the smallest numbers are simply enormous in terms of the amount of consumption that could take place. So I think that the pressure from that is going to be felt, and that might feed itself through to inflation statistics. Certainly the shape of the yield curve is starting to point in that direction as well. So I think that, given all of those comments, plus the likelihood that input costs are going to start to increase as well, and the prospect of wage inflation later on, which would be welcomed. I think all of that points in one direction. When it comes to gold, obviously, everyone knows this, but for thousands of years, gold has been an asset that people have turned to when they are fearful in terms of the impact on paper currencies. And if you're going to lose purchasing power through time, you want to find a way of protecting yourself from that. Gold has served that role time and time again. I think that the challenge in today's markets is that the accessibility to gold has never been greater, but also the accessibility to other instruments that can potentially provide similar service. And obviously, I think that you referenced at the start of this call the extraordinary move higher in the value of Bitcoin. That is deemed to be a scarce asset. People are investing in it because they think it is scarce, and the fact that they're paying so much for it clearly sends a signal on the fear that the printing presses are going to have on the purchasing power of paper currencies. So I think, if anything, real assets are likely to perform well. Equities will probably perform well. Fixed income might struggle, and if we do see inflation coming back, then that's probably going to be good for wages as well.
Just related to that, I just wanted to throw in a question that's come through from the audience, and just a reminder to everybody watching that you can submit your questions using the Slido widget which should be visible on the page that you're watching on, which relates to the previous sort of, or feeds into the previous comment, which is about the implications of US dollar strength, or I guess more recently, really US dollar weakness going forward, and what your expectations are there in the context of what's happening with US monetary policy, and I guess also what that means for the rest of the world. Maybe Fabiana, do you want to start on that one?
Yeah, I think I always follow these expectations for dollar extreme weakness and extreme strength, and I think now there is an expectation that there will be further weakness with the new administration, but we just don't see a real significant trend from that point of view. I mean, we might have some weakness. We might have, if you want some more relief, especially for currency, for example, in emerging markets, which obviously suffer from a very strong dollar. But we would be quite skeptical of thinking that there is, a very strong downtrend in the dollar ahead of us, and we're really not taking that into as a key pillar of our asset allocation at this point.
Rishi, how do you feel about the dollar?
The same to a large extent. I mean, every investment we make outside of the US, we underwrite some gain or loss on the FX side, and more often than not, particularly in the emerging markets, we tend to allow for a depreciation of the currency against the US dollar. And to be perfectly candid, Peter, we haven't changed those underwriting assumptions despite the recent weakening of the US dollar, because as I said earlier, we tend to have a 5-year outlook, and over a 5-year period, even despite the recent weakness led by the expected policies of the incoming administration, we think you'll come back to a more normalized mean reversion, I think, is what we called it earlier.
Okay.
I think it's interesting that every Treasury Secretary until Trump always had a mantra, which was a strong dollar is in the U.S. best interest. It was almost like it was emblazoned upon their head. And it was interesting when Janet Yellen was in her confirmation hearing yesterday and asked about the dollar, she actually read the statement to make sure she got it right. And essentially said that using currency to advance your domestic economy is not what the U.S. does. So walking away, but not exactly going where previous secretaries had gone. I think it's an interesting pivot that we might see.
Yes, well, that could be interesting. I want to turn to the question of China, particularly China-US relations. I mean, Lynn, it sounds like you've been paying quite a lot of attention. You're pretty focused on what this new administration is going to do and maybe do differently. Do you see any big changes in the relationship between the US and China coming up?
I think the US-China position of Trump and Biden is the closest of any issue out there in terms of their underlying analysis of the problems. I think for sure we will see a difference in tone. I wouldn't call it outreach, but I do believe that Lincoln and Sullivan and Biden himself will do more for engagement. But I think on many fronts, from the human rights to trade, to manipulation of data, there's going to be a bit of a continuity underlying.
If I can interject, I would agree with Lynn. If anything, this administration will be less, shall we say, dramatic and more consistent in its policies. But I do completely agree with Lynn that it will still be an administration that will hold China accountable. It is also an issue that is very much in favor of the US public, and obviously the issue of IP is still a very important issue.
Can I add something to that, Peter, if you do? You know, much of the earlier debate around US-China relationship, or the deterioration in that relationship, you know, was anchored around the likelihood of deglobalization and the disruption to trade and so on. One of the things that seems to be coming to the fore increasingly now, putting on the investor perspective, if you will, is the need for investors to allocate, you know, direct capital to US, as they've, you know, done for decades and centuries in the past, but also increasingly to China. Because for a prolonged period of time, you know, the allocation of capital to the growth of the Chinese economy was a little indirect, right? You were going through multinationals, you know, domiciled in the Western Hemisphere that had a large base, and were in turn piggybacking off of that global trade, the globalization agenda that had been par for the course for the last several decades. And that is no longer, you know, available as a route for gaining exposure to the growth miracle of China in the future. So you're seeing, you know, absent sanctions, of course, because as we know, the US has imposed sanctions for institutions, US institutions in particular, from investing in a certain set of names. Absent that, we are seeing for sure an increasing direct allocation by investors into China, whether it's Chinese equities or Chinese assets, broadly speaking.
Yeah.
Actually, Peter, sorry, I will interject again. I completely agree with this. It's not that if you want, the disagreements between the US and China, in our opinion, are going to really affect the investments and investment appeal of China. I mean, we do continue to see a lot of interest in the overall Chinese market, and we believe that China will be destined to become a core location in investors' portfolios going forward.
Do you have thoughts on that, Ava? Do you think people are sort of prepared for that bifurcation bit?
Yeah, I mean, I don't think people need to be prepared for it. It's already happening. So, you know, just in 2020 alone, the gap between the US and China in terms of the size of their economies, you know, narrowed significantly, you know, and, you know, I think everybody is anticipating the Chinese economy to become the world's largest economy. And I guess the time frame of which that happens has come forward as a result of last year's divergence in economic growth. So I think, you know, we have to be aware of that. We all know it's going to happen, and I think that the capital will follow in terms of the investment decisions. So I don't think we need to be prepared for it. We just need to know it's happening, and you know, hopefully pick the right winners in that transition, because it's definitely going to happen to us in the future.
Yeah, so it certainly makes things exciting. I mean, I think what we saw today, that the share price of Alibaba rose as much as 10% in Hong Kong after Jack Ma appeared on a video for the first time in 3 months. So it definitely gives people something to think about. I just want to come back to, just prompted by a question that's come through, just come back to the sort of green investment theme that we were looking at earlier. Question is can the panel think of any new sustainable investment opportunities that offer the promise of a reasonable return? So maybe, you know, thinking about where are the fresh opportunities? Lynn, do you want to start on that one?
Well, sort of tying into what I said earlier about greening versus green, I think that there are opportunities in the big fossil fuel companies that are at 50, 30-year lows in their stock price. And are they willing to switch out their investment base for investors who will back them on their greening process? Clearly, companies like BP and Shell are trying to do that. Will other companies like Exxon follow, or will they just continue with business as usual? Obviously, these companies can't turn off the switch of fossil fuels, or we'll have half the world living in darkness. But I think there is an opportunity in going into the problem and finding brave managements that are willing to pivot. You saw that in the coal industry with companies like AES that were down in the dumps, low PEs because they were coal, and over time they pivoted, and now they're in ESG ETFs. So I think going into the problem, and companies that have scale so they can solve the problem, rather than just, you know, build a wind farm here or a solar panel there, or, you know, green their operations. I think that there are still huge opportunities in that space, and it applies to utilities as well.
I see Evie nodding vigorously.
Yeah, no, I totally agree with Lynn. You know, we've seen the transformation of a number of business models around the world in this direction, and the consequence of that, you know, has seen dramatic changes in companies' valuations. Lynn mentioned utilities. There are some great examples of that in Europe and elsewhere that have gone in that direction. I think also that there are some narrower areas that you need to look at. You know, there are some industries that are on the cusp of technological breakthrough that could have a profound impact on the way that they provide their goods to the market. And we're seeing that take place. You know, certain industries that are very carbon heavy and seeing ways to dramatically reduce those emissions. You know, does that capture the attention of groups that are thinking through an ESG lens? I think another area that people, you know, that's really starting to come to the fore, you know, is the concept of a circular business model. You know, the idea of a circular economy is so beneficial to everybody. And I think that the shift away from this kind of, you know, make something, use it and throw it away, the kind of linear business model that we've all been so used to over many generations, to think about how we can maintain these resources, you know, in circulation and reuse them. You know, the move against fast fashion, the move against plastic, you know, these are all going to have very, very big impacts on businesses. And so not only is there going to be a desire to move in this direction, there's going to be regulatory pressure to move in that direction as well. And then also the end consumer. The end consumer wants to consume in a way that's less impactful in terms of its bad impacts on society and on the world. And if we can find a way that you can consume with a lower level of negative impact, then customers are going to go in that direction. And if you're a business that's providing a good and you're selling your product in a plastic container versus somebody who isn't, people are going to choose the one that isn't the plastic. And I think that shift is happening unbelievably quickly and really, really accelerated in the late stage of 2019 and aggressively in 2020. So I mean, you can tell that I'm sounding a little bit evangelical on this subject, but I think the entire idea of circular business models is starting to gain momentum. And we're seeing more and more companies talk about it. It's becoming broader in terms of its literature. And we're even seeing, you know, circular economy days at the World Economic Forum over the last few years. So it's definitely happening. And I think that's a trend that we have to watch out for.
Can I offer a perspective on a dimension of this? You mentioned sustainable businesses, right? So I'm going to focus on the S side rather than the E side, the social responsibility, if you will. And one of the areas of opportunity, to be honest, that we've backed pretty significantly is capturing two trends. One is the increasing adoption of the benefits of real diversity, right? So, and I think everyone will relate to what I'm talking about, but in particular in the financial services arena, where you don't really see yet quite as much diversity as you ought to be seeing. And I'm not just talking about racial diversity, ethnic diversity, gender diversity, etc. And the other is, of course, you know, back to what we started with, which is the increasing adoption and growth potential for private market managers. There is a scarcity of diversity in the private markets, very specifically. And that, you know, from our perspective, is one area that we feel is entirely ripe for opportunity, in terms of, I think the question was, where do you see an opportunity for new businesses in a sustainable sense? We strongly believe that diverse GPs, you know, or GPs that bring a core element of diversity to the table are on a growth trajectory, is a secular long-term beneficial trend.
Peter, maybe if I may add, you and I have talked about this in the past, but what we've seen in markets in 2020 has been this big headline effect. A lot of investors, maybe a lot of those new retail investors, we don't know, but really running to the same names, running to the same brands. And this has also had an impact on investment in sustainability. So you're seeing the EV brands, you're seeing some of those utilities companies, whether it's wind or whether it's solar. But in reality, there's a whole ecosystem around these companies. There are those enablers that allow them to get to that point of sustainability. There are companies that actually grow in parallel because they make components that are not as glitzy, but actually are used in those same vehicle, in those same utilities. And I do believe that if we just dig a little bit deeper, and the market will eventually, as it gets much better aware of what sustainability really is and what it entails, I do believe that there's still a lot of opportunity out there, certainly in equities.
Yeah, I would also add another area where I think there are opportunities, and that's in the area of food. Because that has everything that Evie was talking about. Consumers are more conscious of everything from the chemicals that are in food to the environmental footprint of the packaging, of the distance that they travel, that the food travels, and I think there's consumer interest in health and the social impact. So those companies, so it's possible. So Coke and Pepsi might be the coal industry of 10 years ago or the fossil fuel industry of today in 5 years until they clean up their act. So those negative externalities that companies are creating by hurting the consumer or hurting society, in the case, Rishi, of your very good comment on diversity, those companies are punished, and they need shareholders who are going to support them in terms of getting it right. That's where we come in as investors. And that's where the ESG movement, to me, is so important if it's focused on solving the problems, not just finding opportunities that don't have the problem.
And Lynn, if I may add, actually.
Evie and then Richie.
Sorry, I completely agree with Lynn. The whole concept around the nutrition space is changing, very, very rapidly. It's a combination of technology and increased transparency around everything that we're consuming, how we consume. That it's breathtaking what's happening there. I think one element within it that people are starting to understand more about today is the concept of extended producer responsibility. We all want to consume the end good that we're buying. We don't necessarily want to consume everything that goes with it. So if you want to, have your drink or eat your yogurt, you don't necessarily want the container. Whose responsibility is that container? Where does that liability exist? Think about the impact on the brand of the companies producing it, seeing that product floating in the ocean with the brand attached to it. This entire idea around cleanup, around reverse vending machines, around that, what is the end value in the container? All of that is coming through very, very quickly. I'm excited to see the change that's taking place here, because I think it's the end consumer, it's the regulator, and it's the technology that are all allowing this change to take place.
Rishi, you wanted to add something?
Yeah, no, I was just actually going to add to something that Lynn said, and actually we also touched upon it. This within the food supply chain, the adoption of socially responsible principles actually goes all the way back in the supply chain. So, for instance, we recently invested in a business that provides fresh seafood to homes. It's think of it as a seafood grocery store, except it's online. It's e-commerce based. But their entire supply chain starts from that fisherman on the boat off the coastal waters of Kerala in India, right? And all the way from there to your table in front of your fork, through the use of technology, as Evie pointed out earlier, through good transparency and good governance, they have created a unique business model that strikes at the heart of what we are looking to build for the future, which is not just sustainable businesses that produce cash on cash returns, but businesses that enrich the lives of all the stakeholders that participate in it. And I think that's really where we feel very strongly the investment universe is going.
I think it's a great point now, and I think Fabiana made the point about the value chain. And the often the hidden value that sits inside the value chain to the as you described it, the kind of high branded companies that catch all the attention. I think the point that Rishi makes is also equally important, which is the value that comes from the integrity of the supply chain. At each incremental step, if you can hold that integrity, the end consumer will pay more for the product, knowing the process that it's gone through.
And the end consumer wants to participate in that, which is a huge change from the past. It wants to have a say.
Okay.
And this also brings us back to a comment that you made earlier, Fabiana, about how to measure all of this. Because we know what people want, but how do we give them confidence that the information they're receiving about the health, about the environmental footprint, about the supply chain is legitimate. So, I mean, I think as an industry, we should work hard across the Atlantic on getting viable measurement mechanisms for all of this, so we can invest behind these companies that, as Colin Meyer said, the purpose of corporation is to solve the problems of people and planet profitably.
Okay, this is a really interesting conversation. I'm afraid, however, that our time is up, so I'm going to have to call it to a close here. But I want to thank you all for participating, and also for taking us on such a broad, covering such a broad range of topics. Maybe we can try and gather you all together in a year's time and see how things turned out. I'm sure there'll be a few surprises in there. But in the meantime, I'd like to say thank you. I'd like to invite our virtual audience to give you a virtual round of applause. And thank you all very much for joining.